All right, so thanks for joining everybody. We've got great attendance today, and we're gonna dive right in. So, welcome to the monthly RO Property Management webinar series. Today we're talking about how to know if it makes sense to rent or sell a property. So, if you own a rental or multiple rentals, and at any given moment in time, every day you have a decision to make: do I keep renting it out or do I sell it? Now, most people don't think about that every day, but they tend to think about it around sort of key milestones in the life cycle of the property. Usually, when a tenant moves out, is when this comes up. So, we have helped hundreds and hundreds and hundreds of property owners think through this decision, and we've seen the numbers on probably close to 1,000 total doors over time that we've managed. And so, what we want to do today is help you understand how to forecast and predict the overall wealth accumulation that you can expect to earn from a given rental, and how to think about comparing that to the wealth you could accumulate if you sold the property. So our goal is to help you think like almost like a financial advisor when it comes to your rental portfolio, backed by 12 years of professional management experience and being a rental owner myself. So just really fast for anyone not familiar with who I am, I have a degree in electrical engineering from Geneva College, worked as an engineer for 5 years, and then started RL Property Management in 2013. We actually just celebrated our 12-year anniversary. I bought my first rental property in 2008, still own that property. My co-founder, Adam Rich, and I went on to purchase several more properties, and that was how the management company got started. He and I also own a local engineering company called Criterium Lisquet. So if you have any engineering needs, if you need a professional engineer's opinion on a structure of any sort, he can help you with that. And I write and speak about property management nationwide. I go to conferences and give talks. I have a newsletter and a podcast for other property managers. So I'm very interested and invested in property management as a subject or as an industry, above and beyond just running a management company. All right, we got some great activity in the chat. So thanks everyone for keeping that going. And we've got several RL team members here in the chat as well. So if you're an RL client or you want to learn more about RL, feel free to drop any questions you have in the chat, and our team will definitely be all over that. So what are you here for? What is this? You are watching a monthly webinar series. It is hosted by RL Property Management, and our goal at RL Property Management is to help you be more successful with your real estate investments, whether we manage them or not. And so we're not set up to manage every type of property in every part of Ohio. And so what we want to do is we want to manage properties when it makes sense. And if it doesn't make sense, we want to recommend either another property manager or some resources for you to help you be successful. And these webinars is part of us doing that. So the information you're going to get today has nothing to do with selling you on RL Property Management, and everything to do with educating you about owning a rental property and how to think through that financially. We took a poll of our property owner clients at the beginning of the year, asking them about their confidence level with their real estate investing knowledge and skill set. We found most of you weren't where you wanted to be in terms of your knowledge and expertise in that area. And so that's what the goal of this webinar series is, helping you develop that knowledge and confidence so that you can be even more successful with rental properties. So what we're going to do today is very quickly look at some company updates in our scorecard for RL Property Management. And then we're going to look at a possible investment opportunity. This is not our listing. This is just a rental property that's available in Columbus for sale right now. We will not make any money off of this if you buy it. We'd love to manage it for you, but no worries if not. Just going to use it as an example. And then we're going to go through how to think about the rent versus sell concept in detail. And we're going to actually show you a rent versus sell calculator that's on our website and is available for free to use. And I'm going to talk through exactly how to use this, what these sliders do, how to change all these different fields to make this completely accurate for a property you might be considering selling or renting out. All right, so RO Property Management shares our data. This is available right on our website, and we update it every month. This is some of the most important metrics that a property management company can use to hold themselves accountable for performance for their property owners. This has started to become something that other property management companies around the country are doing. I know of a handful. I don't know of any other in Columbus that share this type of data like this and keep it updated. But we look at days on market. So when you list a unit with us, how long does it take to rent out on average? How long does it take us to turn over a unit? That's time to turn. Our lease renewal rate, which is how many units, renew their lease. Overall occupancy, average rent, those are self-explanatory. Median repair days. So for an occupied unit, if a tenant submits a maintenance request, how long does it take us on average to get that fully completed? And then rent collection by the 5th, 89%. If you were to run that all the way through to the end of the month, that would be closer to like 98, 99%. But we just look at it through the 5th. And resident satisfaction, we continually survey our residents, especially on maintenance. And they're telling us that on average, they're 4.8 out of 5 satisfied with RL property management, which I'm pretty happy about. Lease renewal and occupancy related? Yes, they are. So the higher the lease renewal rate, the less turns you're incurring, and that's when you have vacancy. And so theoretically, if you have a really quick turnaround time, you could still have a high occupancy rate, even if your lease renewal rate wasn't that high. But it's much easier to retain a higher occupancy rate with a high lease renewal rate because then you're not so dependent on a super fast turn and lease. We had a question, do you guys mostly manage A class? Not really. I would say B class is where we're sort of our bread and butter is. We definitely manage a decent number of A class properties, but we stay away from C and D type of properties. And we also kind of stay away from like super premium A++, like super luxury properties. Like think like Muirfield Golf Course or like super high-end downtown brand new build rental condos. Like we're mostly, nicer suburb single family homes and duplexes and stuff like that. Couple quick updates for anyone who owns rental property in Columbus or in Ohio. There are some significant changes possibly coming to federal rental aid. Think Section 8. There's a big proposed package that has a lot of possible cuts to HUD funding. And so we shared some more details about this in our newsletter. And if you're not signed up on the newsletter, let us know. We can get you signed up. But we went into detail there. And then there's also a ballot right now. I don't know if you all have seen this, but in the state of Ohio, there's a ballot initiative going on. They're collecting signatures to completely eliminate property tax or highly modify the property tax. And that would be wild. I don't even know what would happen if that happened, but we are keeping an eye on that as well. And we'll keep you updated with the newsletter. All right, so here's the investment opportunity. This property, we actually used to manage this property. Sorry, shouldn't have clicked. It's a duplex, and the rents we're going to share at the end. But each side is just shy of 1,000 square feet. It's got central air. That's important, especially right now. Roof is from 2018. It's got some great updates. It's in Whitehall. So it's really close to our office. We're in Gahanna. But we're very, very familiar with this property because we managed it for several years prior to the current ownership. And this would be a great rental for somebody, and it's available to purchase. So at the end of the show today, we will show you the asking price, and we will show you our rent estimate. And of course, we know what it used to rent for, so we're very familiar with it. And then we will show you the rent versus sell sort of graph showing wealth accumulated if you were to purchase that asking price and get a mortgage with today's rate, sort of like the next day, if you were to think about selling versus renting, what would that look like? All right. Hope I'm not going too fast. I tend to talk fast, and I just had a Coke. But I want to keep everyone's attention. So, definitely ask your questions in chat, and I'll keep an eye on that. And there's like a Q&A feature as well that we can look at. Looks like we don't have that turned on, so that's fine. Just ask in chat. All All right, so we're going to get into the meat of it now. How do I decide whether to hold on to my property as a rental or cash out? So you can think of this decision similar to owning a stock, right? If you were to buy stock in Apple, let's say you bought $100,000 of Apple stock, every day you have a decision of whether to sell that stock or hold it. And you could also buy more. But basically, for that specific stock that you own, every day you wake up, markets are going up and down, stock prices going up and down, world events are happening, tariffs, whatever, and you're making a decision on, do I sell the stock or do I hold the stock? Do I sell the stock or do I hold the stock? And you can think of properties in the same way. Now, obviously, it's much harder to sell a property than it is a stock. Real estate is considered to be quite illiquid. That's like a fancy investor term, which means it's harder to dispose of, harder to trade, sell, buy, etc. But in the same way that the stock price of any specific stock goes up or down depending on what other people think about it, the value of a home or of a rental goes up and down as well. And the price, like the stock price, which you can think of as like the sale price for the home, the market price for the home, it may fluctuate independently of the underlying value of the asset. So just like a stock price can go up or down, you could have 5 or 10% swing in a stock price of a specific company on any given day. That doesn't mean, if you think about what's happening in the business, what's fundamentally changed from Tuesday to Wednesday at, Apple Computer? Nothing has changed, but investors' opinion of what they're willing to pay has gone up and has gone down. If you're a follower of Warren Buffett, you may have heard that referred to as Mr. Market. What is Mr. Market willing to pay me today for my stock? It's this exact same thing with properties. It's just that you don't have a ticker price. You don't have a stock ticker for your rental that you own. So you're not quite clear on what other people might be willing to pay for it until you take it to market. So the process of taking a property to market is very expensive and very time consuming and very opaque. And so it makes it much trickier to decide at any given moment in time, should I sell or should I continue to rent it out? And we're going to help pull back that curtain a little bit for you today and help you understand the things that you should be thinking through when you're making this decision. The price that you may fetch in the marketplace, in other words, how much you could sell the house for or the duplex or whatever, you can come up with some estimates there, but it's never going to be as accurate as a stock price. The harder thing to calculate is what's the expected performance of that asset from now. With a stock, you have some forecast you have some guidance that's given to you by the management of the company, and you have some analysts that are really looking carefully at those things and can forecast out a little bit. But with your property, no one's doing that for you. You have to be the one to do that math and figure that out on your own. And that's what we're going to walk you through. All right, we're going to kick off with a poll. What is or has been your top priority when deciding between renting or selling? Pull up that video, Jamie. Pull up that poll, Andrew. And we will we will see what you think. I'm really curious to see the results here.
Yeah, we've got a pretty clear winner. We'll give a few more seconds in case anyone else wants to vote here. We got about half of the attendees chiming in. Looks like we're kind of steady there. So I'm going to go ahead and end it, and we'll show the results.
All right. So long-term wealth building, clear winner with 75% of the vote. Number 2, immediate cash from a sale or rental cash flow. So that makes sense to me. Those are top considerations when deciding to rent or sell.
Mm-hmm.
All right, so let's get into this. So here's some reasons that people hesitate and sort of pull the ripcord and eject from their rental properties, meaning they decide to sell. The most common reason that we see, and just to give you a little bit of context, we actually just surpassed 700 doors under management today at RL Property Management. Very exciting time here at the company. But we've seen on any given month, we have anywhere from 2 to 4 owners part ways with us out of 340 something owners. And usually it's to sell. That's the most common reason that people leave. And so we see what causes people to sell. What are the common scenarios that property owners decide to cash in their chips? And the number one reason that we see, is it has to do with the turn costs and having a vacant unit. So when the property becomes vacant, that is a moment in time when income stops flowing in, and there are potentially large expenses to be paid out to get the unit ready to rent again. And that is a moment when people decide that it has become emotionally and financially challenging, and they basically don't have the stamina to keep going. I don't get the sense that folks are performing any type of a financial analysis when they make this decision. They're simply looking at cash out of pocket. That's the sort of benchmark that they're using. And unfortunately, that can lead you to make some really poor financial decisions for your family. And so what we're going to help you do today is give you some tools and some confidence to look past the next few weeks of pain, zoom out to 5 or 10 years, and decide at that point and through that lens, does this make sense to sell or continue renting out? And the stakes are high. In a lot of the calculations that we run, we find that the swing between renting versus selling in terms of wealth built over the next 10 to 15 years is tens of thousands of dollars. So we're not talking about small differences here. We're talking about very material money. And so for me, as an engineer especially, that's something I want to take a little bit of time with. I want you to ask yourself how much time you spent planning your last vacation, which was possibly a $1,000, $2,000, $4,000 type of expense. You probably spent many, many, many hours researching flights, researching hotels, putting together an itinerary. That's the type of time investment, if not more, you should be making when you're analyzing a decision like this. It's not something where you just you get frustrated one day and you call your realtor buddy. I want to help you think through that a little. And by the way, that doesn't always mean you keep renting out. Sometimes when we run this analysis, it's clear that you should sell. And in that case, I want you to sell, because if you keep it when you should have sold, it doesn't perform well, and then you get frustrated with us, your property manager, and no one likes that. So in that scenario, I'd rather see you be successful with a sale. Okay. Couple points on how to think through this decision, or the right mindset that you want to bring into considering whether you should sell or rent it out. You need to think about your property as an asset, not as a home. And I know for a lot of people, they used to live in it, or there's a family connection to the property even. But regardless of the history of it, if I were to advise you as a financial advisor, I would tell you need to think of it like an asset. And so the specific hardwood floors or the curtains or the landscaping, the attachments to these items should be set aside, and we need to think through, over the next 15 years, what's the best financial decision for my family and for my wealth, rather than this sort of emotional attachment that's easy to do with a home. The right way to think about it is every property is a micro business that somebody lives in. I heard this phrase one time and I love it. It's so true. And as your property manager, we're basically your business manager. So every property that you own and that we manage, we treat that property like a micro business. We have income in the form of rents, and we have expenses, and you have an income statement just like a business would. There's actually a P&L that goes with it, and a balance sheet. So it is accounted for like a little business, and you should think about it like a little business. You should think about, is this business performing well for me? Do I want to own this business? Again, that's how Warren Buffett thinks. Or is this business not doing so well and I need to sell it and reinvest the money in something else? It's a question of asset allocation. Properties that you own are assets and you have equity in them and you may have debt on them. And so it's a question of how do you want to allocate your assets? Um, it's not, like the question of how much money is coming in per month is a very small part of the overall consideration of whether you should rent or sell. When you're looking at it from an asset allocation perspective, that's the right frame of mind to put on. And we're going to get into a lot of those details. So the sort of long and the short of it is when you sell a rental property, you are typically going to pay capital gains taxes on it. Now, there's an exception here, which is if you've lived in the property for at least 2 out of the last 5 years. I think it's either 2 or 3 out of the last 5 years. There is a capital gains exclusion. I want to say it's like $250,000 for a single person and $500 for a married couple. So in that case, you may not pay income taxes. But if you haven't lived in the property for 2 out of the last 5 years, then you will pay typically the long-term capital gains rate, which depending on your specific tax situation is usually around 15%. So whatever you think you're going to make on this property, just lop 15% of it right off the top to taxes. And there's a bunch of other fees and transaction costs that go into selling a property, which we're going to look at when we get to the calculator. And then on the flip side of holding it and renting it out, you've got some long-term equity that you're going to build up and appreciation. The idea of like a short-term win where you sell the property, pay the taxes, and take the cash. The right way to think about that is not that like sure, you may have made some money right then and there, but then what are you going to do with that money? How's that money going to continue making money for you down the road? When I think about my financial future, I tend to think in like a 50-year time horizon, right? So just because I made some money in 2.5 years of owning a rental property, that's almost irrelevant to me. I'm thinking over 50 years, how can I maximize outcomes for my family? How could I make it so that if I wanted it to be so, my grandkids wouldn't have to work? That requires thinking much longer term than, oh, like I paid 100 for this property and now it's worth 250. I'm just going to sell it and take the money. Like that's actually a bad decision because now you have to go and figure out how to reinvest that money to earn at least as much as you were making with the property, not to mention the added hassle of having to sell it and everything else. So that's just a little bit of how I think about these types of things. This question of what are you going to do with the money, basically the opportunity cost, we're going to get into that when we look at the calculator as well. So at this point, I'm actually going to jump right, or I think we might have one more poll. Yeah, I'm going to skip that slide and go to the poll. Let's do this poll, and then I want to jump right to the calculator and start diving into, I think we're going to try and do a real world example here. And maybe we'll take a volunteer if anyone's interested and has a specific property. So for poll 2, which of these factors do you feel least confident evaluating? Capital gains taxes, reinvestment opportunities, long-term equity growth, rental income forecasting. These are like 4 of the very main inputs that are going to go into this calculator. So we're going to dive into all 4 of these. None, I'm very confident, or something else. So all 4 of these are, if you don't understand how to think about these 4 things, you will not be successful in accurately deciding whether you should rent or sell. Now, obviously, you can do what you want and make your own decision. But if you want to make sort of like the technically best decision, you need to have a grasp on these 4 concepts. You guys loving this? I mean, this is kind of dry. I hope I'm making it a little interesting for everybody. But give me a shout out on the chat if this is, if you're finding some of this relevant and interesting, or if there's anything you want me to talk more about.
Loving it. Great topic. That's what people are saying. All right, we got about the same 16 people voting here. We'll end this and share some results here.
Very interesting. So out of these four, folks are least confident looking at reinvestment opportunities. So I'll make sure we spend some extra time on that in the calculator. Number two being long-term equity growth, right? So that's like for this specific property, how can I decide or think about how much my equity is going to grow over time? So great results there. All right, so we're going to go to the calculator. So I want to ask the audience, do we have any volunteers who has a specific property that you own that you would like to see me run through this with? If you own a rental property and you want to see what it looks like on this graph, rent versus sell, I think it would be cool to run through it with somebody. And so put in chat if you have a specific property. Now you're going to have to share some details like what you paid for it. It's public, but we're also going to need to understand your mortgage and your balance that's left on it. Okay, great. We have a volunteer.
Yeah.
All right.
And
24.
Era's raised their hand as well. So if we want to maybe do two later, but
Okay. We'll see if we have time.
okay.
So Victoria wants to understand 2452 to 2450 Hiawatha Street. Is that a duplex? And we used to manage. Several.
2450 is a correction, so
Okay.
maybe we can focus on 2450.
We used to manage several properties on Hiawatha. Actually, we currently manage 2961 Hiawatha. I think. Yeah. 3 duplexes. So Victoria, if you don't mind, let's pick one of the duplexes. And then give me your best estimate of the current value of the duplex and the address as well, and we'll start digging in. This is going to be fun. I don't know if the screen share is following me, but I went over to the auditor's site and grabbed 2450. We're going to assume that's the one that we're looking at here. You still with us, Victoria? If you have an estimate of the value of that one and your original mortgage amount, and then the mortgage balance and the interest rate. So while she's doing that, I'll start talking through what you're looking at here. So, okay, you bought all 3. Wow, this sounds like a great deal. So we'll use 1/3, 439,700 divided by 3. So let's say, actually, you know what? We could use this. We can just do all of them together. Now that I think about this, 520,000, price paid 439,700. Did you have a mortgage, or maybe you didn't have a mortgage? So by the way, these lines are going to jump around all over while we're editing this. Don't pay attention to these lines until we get to the end. So current value 520, price paid 439. Yeah, tell me both if you can, what you owe and the original mortgage balance and the interest rate. And you can just guess, like it doesn't have to be exact. All right, I'll look up the property taxes. So if we go to, scroll to the bottom here, 2024 taxes, 2,100. Now, is that for, I'm wondering if that's for all 3. I think that's for all 3. I'm guessing it's 2 bedrooms each. So I'm going to change this to dollar and put in the actual amount. Oh, wait, that wasn't right. Yeah, 2106. Okay. 2 are on one parcel and 1 is on its own. Okay, we'll figure it out. All right, so you guys are kind of following along with what I'm doing here. I'm putting in the current value, what she paid. We're going to get the mortgage details and pop that in. That's going to fill in the mortgage payment. I'm filling in the current property taxes, and we're going to go through some of these other things. And the calculator in the background is trying to figure out how much money is flowing to Victoria every year. And
Peter, is that property taxes for the year or is that per month?
oh yeah, that's for the year.
So divided by 12 is 175
Okay,
and 50 cents.
great. We pay $10.53 every 6 months on one and $19.48 on the other two. $10.53 every 6 months. Oh, that's the taxes you're saying? Okay.
Yes.
So that works out to $250 a month altogether. Insurance, let's just assume $200 a month. Maybe she knows. Monthly rent, we will actually, if you know the rent, Victoria, we'll put in the actual rent. And I'm going to assume this was not a primary residence, so I'm going to uncheck that. So what you're looking at on the graph here is like years out from today. And this line, which you can click around and move this line around, drag it around with the slider. You can see that's updating the numbers down here. And so current assumptions, which we're not done yet, but let's just pretend 5 years out, if she sold today, she would lose $75,000 compared to holding it and renting it out. Now, again, we're not done yet, so I wouldn't take these numbers as final. $6,600 approximate rent, okay? Wow, that's great.
Mm-hmm.
Do you have a mortgage on it? And this table here gives you a detailed breakdown of what goes into this calculation. So you can see right here, the highlighted row is the 291. Well, how did we get there? Well, we started in year one. We're assuming 72,000 in rental income, 9,500 in costs, $0 mortgage while we're getting that info. So that assumes a net cash flow of 57,000 for that year. And then we're looking at home value, home equity. And so this is total wealth with the equity plus the rent. And this is the wealth if she sold in that year. And I'm going to explain how we got some of these numbers because there's more to edit as we scroll down. And that's how we got to that difference. And then over the years, it adds up. Rental income. So Allison asks, why is the rental income lower than 6,600 times 12? It's due to vacancy loss. So you'll see as we scroll down, there's a vacancy loss percentage that you can pop in. Unpaid balance 317.66. Let's make some assumptions while she's looking it up. 80% of 520,000. Monthly mortgage payment is $21.73 a month. I wonder if I can just pop this in directly. Yeah, that makes it easier. And insurance is about $3,500 a year. Man, we're getting all the data here. This is great. So that is $291.66 or $292 a month. So we're getting really accurate here. Victoria, that might be everything. Let's keep going here. So I want to scroll down and show you some of the other assumptions that we're making. So make ready costs is how much, like if you have a vacancy right now and you're thinking through this decision, make ready costs would be like how much the turn would be. How much would it cost to get that unit ready to rent again? Which I don't know if she has a vacancy right now, but we'll just leave that. Annual maintenance costs. So it's looking at 1% of the rental income set aside for annual maintenance. I find that to be a little low. So let's go ahead and bump that up. Let's even go crazy and use like 4%. Refurbishing costs to sell now. So that would be like, again, if you're in this rent versus sell scenario, if you want to take it to market, how much would you have to spend to get it ready for sale? In other words, all right, let's just pop 8,000 in here for a make ready cost. She said it's anywhere from 4 to 10K. Mortgage term, so we don't need to worry about that because we just popped in the mortgage directly. Management fee per month. So if you are with RL Property Management, this is 3 units or 6 units? Do we know? Is it 3 duplexes or 3 single families?
I think it's scroll.
6 units. 3 duplexes. Okay. So if you're with RL, you're going to pay 6 times 137. There is a discount. I can't remember, but let's pretend it's 10%. So that would be
Yeah, I think it's
822 a
10%.
month. Let's say it's 10% off that, so 740 a month. I'm just going to convert this here. Oops. 740 a month in management fees. Vacancy rate of 8%. I find that to be a pretty good number to use, so I'm going to go ahead and leave that. Capital expenditures. We have this at 5% of rental income. Let's even bump that up because my guess is these properties are older, so we may need to increase the CapEx that we set aside, and we're going to include that. Annual rent change. So how much can we expect the rents to go up every month? So she said they're $6,600 for 6 units, so that's $1,100 a unit. I think 3% is probably a good number for that rent. Realtor commission. So again, for the sell side of the calculation, how much are we going to pay a realtor if we take this to market? I think 6% is, you could probably beat that if you really pushed on it, but let's just leave 6% right now. 3% in other closing costs. Sellers typically pay a bunch of closing costs, so we'll leave that at 3%. Income tax rate, 10%. So that's probably low. Let's bump that way up. Let's say you're in like a 28% marginal tax bracket. And capital gains tax rate, I was talking about earlier. So if you were to sell this and you haven't lived in it for 2 out of the last 5 years, what are you going to pay on the gain? It's typically 15% if you've owned it for more than 1 year. And then it can be lower if your income is really low, but usually it isn't. After tax reinvestment rate. So this last thing right here is one of the most important fields on the whole calculator. What this speaks to on the poll, the thing that most people were uncertain about. In other words, what's going to be the return on investment if you sell the property and invest the cash? So if Victoria were to sell this property, currently worth $520,000, mortgage balance of $317,000, so she will walk away with $202,000 before all fees. So there's going to be around 10% lost to like realtor fees, closing costs, make ready costs, and everything else. So that'll leave her with like $180,000, and then she's going to pay 15% on that. So that will leave her with about $135,000 to invest. So if you took $135,000 and invested it, let's say you put it in the stock market, in an index fund, or maybe you invested in another property. This question is like, what's going to be your return on that money every year? So if we took $135,000 and we're making 6% on that every year, that's $8,100. So if I gave you $131,000 today, how much money do you think you can make every year with that money? Well, if you put it in a bank right now, you're going to make like 4.5% or something like that right off the rip. So that's pretty good. If you were to invest it in the stock market, you're looking on a long-term basis, on like a many decades, Stock market averages around 9%, 9 to 11%, right? So depending on what you think you're going to do with the money or how good of an investor you think you are or what other opportunities you have access to, you should move this number up or down. If you're very risk averse and you don't like putting money in stocks and you don't want to, you'd rather just leave it in like a savings account, then you would put this pretty low, like I said, around 4.5%. If you have access to some sort of, investment opportunity that you think is going to be really great and you're feeling pretty good about that, maybe you bump this up. You're like, hey, you know what? I'm investing in Bitcoin and I think I'm going to, earn 20% a year every year. Well, I don't agree with that, but hey, the calculator lets you do that. So let's just pretend you are going to get 10% on your money on that approximately $135,000. And let's see what the calculator looks like. Ready? I'm going to scroll up. All right. So this calculator is showing you're going to do much better, Victoria, by renting out this property instead of selling it over any time horizon, basically.
Wow.
After 10 years, you're looking at $300,000. Actually, almost any year, you're looking at a $300,000 difference in rent versus sell, just due to the high cash flow nature of this property and the high costs associated with selling it. So really interesting to see this. Where's the reduction in mortgage amounts reflected on the table? Actually, that's a great point. I don't know if we did that right. Let's pretend. I don't know if I did that right. Let's pretend the original balance was 351 because that's 80%. Yeah, I'm not sure about that.
So if there's a mortgage balance input, it will automatically determine the mortgage payment.
Okay.
And then if you override it, the mortgage payment.
Oh, that updated the mortgage payment, but that's
Yeah.
not actually the payment.
Right.
Yeah. $21.73 a month.
So see if that affects the mortgage balance. But
Okay, this looks better. I think it was thrown off before because we jumped right to the payment without putting in the original mortgage. Okay, this makes more sense because I skipped a step and went right to the mortgage payment. So I feel much better about this now. So over 5 years, you're going to make $80,000 more if you hold on to this property. Given all the assumptions, and we made a lot of assumptions. You could spend some more time with this table and really narrow this down. Like you could, we could work with you to get a much more accurate number for things like vacancy, CapEx, annual maintenance cost. So some of these things we could zero in on and get a lot more accurate with. If you were to, let's say you could make 20% somehow on the proceeds from a sale. Let's see what that does to it. So now you can see that it's a lot more closer of a decision. And in fact, in a lot of cases, you'd be better selling. So you can see that your opportunity costs of holding on to the property versus your ability to reinvest that money and make a good return really affects this decision. If you're more conservative and you're like, you know what, I'm not going to do anything with the money except leave it in a savings account. In that case, you're only earning 4.5% on the proceeds. It makes it even more compelling to hold it as a rental. So it really changes the outcome depending on what you're going to be doing with the money. So I will click export as PDF. And actually, Victoria, I can email this directly to you if you DM me your email address. That way you can get a copy of it to save. So we've had some other, so Erez put in an example with all the numbers there. I'll see if I can quickly pop that in. So if you want to see this, by the way, if you go to our website, rlpmg.com, click I'm an owner and rent versus sell calculator.
I'll link it in the chat here.
Beat you to it.
Oh, nice.
All right, Victoria just sent me her email address, so I'm going to stop sharing for a second, and I will get this over to her. All right, I just sent that, Victoria. All right, let me share my screen again. So Bob is asking, all right, we've got some questions here. Let me take these questions. So Erez put in another example. I'll see if we can get to that. Jeff is asking, can you show how real estate taxes impact the calculation by only changing real estate taxes to 0 and then showing the difference that one change makes? Yes. So let's scroll down. Let's go back to the one we're working on here. All right, let's bring the after-tax reinvestment back to like a 10%, which I think is fair. And you asked about getting rid of the taxes. So there are ways to avoid this. If you do a 1031 exchange, you can pay no tax, or you can basically defer the tax. I don't know if 0% will work, so I'll put 1% just in case it doesn't mess up the calculator. So if we do that, it tightens up the change. So after 5 years, 86,000 versus, let's put it back. Let's put it back to 15%. 80,000. So not a huge swing, but it is material. Basically, that's like less money you have available to reinvest is what's swinging that. If you are reinvesting in other real estate, how do you reflect that in the after-tax reinvestment rate? So if you're reinvesting in other real estate, got 2 scroll bars going here. Let me see if I can figure this out. There we go. You need to be able to then forecast the return that you're going to make on your new investment. And so you would basically run through this same scenario, or you can use there's a million of these online like ROI calculators that you can use. But let's pretend, to make it really simple, that you took the $130,000 and you put that money into buying 2 duplexes, and you put like 60,000 down on each duplex, and you, at the end of the day, were collecting $6,000 a year in net rent income. So after paying the mortgage, after paying your property manager, after paying taxes and everything else, you were left with $6,000 a month in rent on your $60,000 down. That would be like a 10% return. Now, that's usually actually pretty tough to do with rental properties. Now, just like the calculator shows, there's all these other advantages of investing in real estate. So it's harder to use this to, if you're looking to like compare holding this property versus another property, you would almost have to run through this whole exercise with the other property to understand your true ROI and then put that number back here. So that's how you would do that. What about so Bob is asking, what about refi, cash out to invest in similar properties for a long-term hold? Yeah. So you could definitely do like a refinance if you have built up significant equity. That's going to raise your monthly payment, but it frees up cash to go and reinvest. That's kind of beyond the scope of what we're looking at here, but you can definitely model that out. And you'll end up with a pretty clear answer on whether it would make sense to do that. Again, forecasting your return on an unknown property that you don't currently own and haven't even identified yet is risky, right? It's it's hard to forecast what you're going to make on a property that you've never even seen and you don't own yet. It's much easier to forecast what you're going to make on a property you own today. So, so Allison's saying, using the calculator, I could not come up with a scenario where it would ever make sense to sell based on one of my rental properties. But at some point, the deterioration of the property should make keeping it less attractive. So, Allison, what you're probably running into is that over time, there is deterioration happening at the property, but this money that you're spending on the capex, this, whatever you set for this percent here, and repairs, annual maintenance costs, that's going to be, it should be offsetting that, right? So over time, you're going to have to upgrade kitchens and bathrooms and siding and windows and roofs and all that. That's all capex, and that should be captured. You should model that in your forecast. And the other thing that's happening over time is rents are going up. So we assume 3% per year for rent increases over time, and the property's increasing in value on top of that just due to appreciation. So that could be very accurate. It just depends on the details. A lot of those details can really make the difference.
Peter, what's a good CapEx assumption people should make for, let's say, a newer property versus a much older property?
If you have a newer property and you're only holding it for a short time, you can lower those CapEx numbers almost to zero. But if you're trying to model holding the property for like 10 or 15 years, it actually is going to be similar, because over the course of that time period, you're going to end up replacing many, if not most, of the major CapEx items. Or if you don't, it'll be reflected in a lower sale price. And so on a long enough time horizon, whether the property's new or used, so to speak, it all kind of works out. It takes a dollar amount per year to maintain a structure. And you kind of like cheat for a little while the first few years when it's brand new, but then it gets into that same cycle of windows last 20 years and roofs last 25 years and siding lasts 15. And it ends up kind of all modeling out. So Jeff was asking about real estate taxes, not the income tax. Yeah, I mean, you could do this, Jeff, like just in that case, that is up here, property taxes. Yeah, you would just, zero this out, and you can see it instantly updates. Okay, so where are we? We are pretty much at time, actually. I want to make sure we have time to go over these last couple slides. So at RO Property Management, we partnered with a company called Lineage that will help you walk through this. Lineage actually has built some really nice interfaces for helping you forecast your rental portfolio and present you with properties that are available for sale. So if you're a current RO customer and you want to learn more about Lineage, reach out and we will hook you up with them. They're a really great company. There's a QR code here too if you want to book time with them directly. You may have noticed that like the statements you're getting from us are not built or are not set up to help you evaluate your property in this level of detail that we just walked through. And that's because we're doing basic property management, and what I just walked you through is what we call in the industry like an asset management level of analysis. And we recognized that we're not set up to be able to provide that for all of our clients, but that's exactly what Lineage does. So if you're a customer of RO Property Management and you would like an asset management lens through which to think about your portfolio of properties, or you want to think about growing your assets under management, Lineage is the solution for that. All right, let's look at the property on Collingswood. It is listed for $235,000. We believe you can achieve $2,250 in rent if you look at both sides together in current market rents. And one of those properties is currently vacant. We're assuming $10,000 in repairs to that vacant unit. If you were to pay asking price, here's how it models out. Over 10 years, you're looking at $117,000 in gained in total wealth relative to basically selling or essentially not purchasing the property. Again, this is not our listing. I don't know anything about this property other than the fact that we used to manage it several years ago. If you are interested in purchasing it, grab these numbers down, give them a call, and I'm sure they'd be more than happy to set you up. I'm a real estate broker, and we are a real estate brokerage, but we are 100% focused on property management. That's all we do. So even though I could theoretically, represent you to help you buy this unit, I wouldn't be doing it. That wouldn't actually be a good thing for you because I've never done that. I'm not experienced at it. We are better off focusing on our clients and their properties. Okay. Any last minute questions? We've got about 3 minutes left. And I'm sorry I didn't get a chance to go through that other example, but hopefully with the demo I just gave, everyone here can grab that link and run through your own scenario. And we're going to have the recording sent out as well because I know I ran through that pretty quick. What do you think, Andrew?
That was awesome. I love the detail. I learned a lot on that too, and I built the calculator, so it's it's yeah, super important stuff. And yeah, like you said, we'll send out a replay so you can kind of poke through this bit by bit and follow along with your own property. Um, and then yeah, I put the links to not only Lineage, but again this calculator there in the chat. So go check it out and run some of your properties through. It's good stuff.
Awesome. Well, our goal is to help you be successful with your rental properties, whether we manage them or not. I hope this was helpful toward that end today. And Andrew, what is next month's webinar and where can people register for that?
Yes, let me get the registration link ready. Next month, we are going to be talking about rent ready, right? So when your property has a turn, or maybe you have a new property you're bringing on to be managed, what does it really take to get that ready for the market? Well, we're going to talk about that, especially with modern standards. We'll break down the hidden costs and some of the delays that come along with like almost there turns, right?
Mm-hmm.
And how professional standards can really speed up leasing, can attract better tenants, and protect your investment long term. We're going to have 2 or 3 people from our leadership team here at RL really doing a deep dive on that. So it's going to be really good. And I've got the link right here to register for that in the chat.
Fantastic. He just dropped the link to Zoom there. And of course, that'll be going out through the newsletters that most of you are subscribed to as well. So you'll see the Zoom link go out through there. But really appreciate everyone's time today. We're ending right on time. This was really fun. Victoria, special thank you to you for playing along and sharing those numbers. I know that was you were kind of being vulnerable there and sharing your investment. Really appreciate that. I think it made it a lot more fun to work through it with a real example. So that was awesome. Thanks everyone. And I am off in June, but I will be back for July. And as Andrew mentioned, we've got several of our leadership team members from RL who will be hosting June's webinar, and we'll see you then.
See you, Peter. Bye, everyone.